our wrap up of our first quarter. I'm Erik Brenner, and I'm here along with Beth Foley and Cliff Hawkins and Matt Aurenz. He will be joining us momentarily. We're really happy that you've joined us today or watching us on the recording. So if you want to go back and rewatch this, you certainly are welcome to do so. We will get out all that information after this webinar. We had planned this webinar actually for some time to do this and do a wrap up of the first quarter. And of course, we've had a lot change and a lot happen that, just over the last week and a half or so. So it's very appropriate and very timely. You will see in your in the webinar platform, there's a place to submit us questions. So if you have questions, please do so. You can type them in, and we will try to get to them as well. We've had a couple questions as well submitted, and we know we're all talking to clients every day. So, and then we have a couple graphics that we're going to share with you and talk it through to kind of help support. So why don't we kick it off, and maybe I'll let Beth start and kind of recap of the quarter. And of course, the quarter, Beth, unfortunately, is kind of focused down to the quarter less many weeks, right? The last week of the quarter, and as we get into the first quarter and how we're thinking about things.
Well, it's been quite the quarter, hasn't it? I can't help but think I have been doing this for 35 years, and I have been through a lot of unprecedented events. And the market conditions over the past month certainly rank up there with some of the most fastest moving changes, and having to be nimble and pivot as needed, which we've been trying to do within the portfolios, and actively managing based upon the discipline that we've established and how we manage the assets, looking for the data to indicate, where we go and what we do. That I know my colleagues here, we're all talking with our clients, and there's just a bit of uncertainty of where we go and how we get there. And I think it's just a matter of staying in tune with the information and staying with the discipline that we've established over the past number of years to get through this.
Yeah, really good point. And I'm going to bring up, Matt, I'd like to talk a bit about the data. We talk a lot about the data, and that our partner Helios Quantitative Research that we work really closely with, and, we're really proud of that. Our decision-making process is data-driven. So if you could just share with everyone kind of, how we're thinking about it, and let's go through a couple of these graphics.
Sure. I'm hoping everybody can hear me okay.
Yep, we got you, Matt.
Okay, great. So the graphics are a little small there, so I'm going to try to switch my screen. Here we go. I think the main thing that we're beginning to focus on when it comes to just tariffs and what's going on there. I think it's obviously the biggest concern that the market is trying to figure out. And I know our update last week, we talked a lot about the economy versus markets and two kind of separate entities, but tandem at the same time. And so the market is really responding to the tariff and how that's going to influence the economy. And the difficulty there being that it's whipsawing constantly because there's nothing set in stone, and they're changing daily, and so the market's trying to adjust accordingly. But when you look at the tariff rate historically in the bottom left-hand corner there, I think that kind of gives you an indication of things ramped up really quick, and primarily due to really almost felt a little bit like a shouting match between a couple countries and us, and really who's going to be able to put on bigger tariffs and the retaliation and what that's going to look like. But when we start looking at, okay, what's that actually going to do to real GDP and market growth and the economy, the expectation is probably not overly crazy on how it influences GDP in the long run. The expectation is that, we would see markets and corporations begin to stabilize a little bit. Consumer spending is still strong. That's going to help But again, the data is heavily in our favor at this stage of the game, but the data seems to just be consistently influenced with what is going on. So that tariff impact, I think, obviously would diminish some of the returns that we would expect in equity markets this year if they're prolonged. And that's just primarily due to revenue and people spending money in corporate profits. So there is a concern, but it's not one that we're saying the sky is falling yet. And we do think that a lot of this will get resolved when it comes to tariffs.
Yeah, thanks, Matt. And on this screen, one of the questions that we had was, and if anyone wants to jump in, but is the U.S. dollar, and kind of there's a lot of noise out there about the U.S. dollar and the impacts of it, and how are we thinking about that? Maybe Matt, if you want to start us out.
Yeah, sure. I think the U.S. dollar, the main thing there is just that as that begins to soften and weaken, the concern being, while that declines and Treasury yields have climbed, particularly on that 10-year, that inverse relationship there just kind of creates a little bit of concern. And I think that concern has bled over into the Trump campaign or their administration to say, hey, we really need to take a look at this in a greater detail. Because a lot of that has to do with other countries holding their sovereign debt in United States currency, and so as they're buying into our debt, if GDP doesn't look as great, they're saying you're charging us more in tariffs. They're saying, hey, we kind of want to be compensated on the back end for holding our reserves in your debt, and so that declining dollar is somewhat of a concern. It also strengthened pretty quick. So it grew rapidly. And so it's really kind of come back down to pre-election stabilization. So again, it's just this whipsawing effect that's going on right now. But that is a concern that I think the administration has been paying attention to.
Yeah. Thanks, Matt. So if we move on to rates and the Fed, maybe Cliff, you could kick this one off on rates. We've talked a lot about it. We've had a lot of questions. In fact, there were a couple questions about rates and, do we see the Fed coming in and doing some emergency cuts, and how we're thinking about that.
Yeah. So the most recent data we've received, has suggested a shift, and it's been shifting actually, throughout the year as to how many projected rate cuts there might be. As of data we received today, actually, we're projected to now have 4 rate cuts throughout the year. The biggest concern is, the Fed is potentially going to have a decision to make if inflation continues to rise. There's an issue, and if jobs start to decrease, there's an issue. So they're going to have to figure out, how they want to fight this if it comes to that. With that being said, the pause in the tariffs, could be something that's helpful, because it could allow us to have some negotiations that will kind of ease things a bit and allow the Fed to not have to jump in and do an emergency injunction, but to actually just follow the data, which is what they're designed to do. But we're not going to know that until about another 70, 80 days, when the negotiations are done and we see what the actual tariffs look like. But that's what we're seeing right now is a projected of 4 rate cuts for the balance of the year.
Yeah.
Hey, Erik, if I can.
Yeah, sure, Beth.
A moment. This past weekend, I heard a comment made by Austin Goolsbee, who is the chairman of the Chicago Federal Reserve Bank. And Mr. Goolsbee has a great way of simplifying things down to very understandable chunks. And he was asked the very same question of, what is the Fed going to do? And they do have a split. The Fed has 2 jobs to do. Their job is to control inflation, keep it low, and work toward full employment. So he was asked a similar question, and his response went something like this. He said, I live in Chicago. We have all kinds of weather patterns in Chicago. And they have a saying, like most of us do, that there's no such thing as bad weather. There's just bad clothing. And what he said is, we just need somebody to tell us this is what the weather is going to be. And we'll make the adjustments that we'll need. We'll pull out what we need out of the closet and get on with our life, regardless of what the weather is doing. And that was his analogy to current markets and inflation versus employment. Just give us a direction to run on, and the Fed will be able to figure out what is the best possible thing to do. And my add on to that is that, in capitalism, there's a way of getting return on investment regardless of the conditions, as soon as you know what the conditions are going to be, and have them be consistent for a period of time. So I liked what he had to say in simplifying how the Fed may react and when they might react, but just kind of looking for that consistency. And maybe this pause, the 90-day pause in additional tariffs, will give the Fed some room to see what to do and when to do it.
Yeah, thanks, Beth. That's really good, and I like that analogy. The one thing that we're seeing with our clients is that really we've given up kind of the last, certainly this year's worth of growth, but a lot of people have been surprised that if we look back over 12 months, we're still positive on the overall portfolio, and we pull out this chart. I know there's a lot of numbers on here, but over the years, all of us have been doing this a long time. We kind of pull ourselves back and kind of reiterate really how many down years there are, and how quickly it can turn. And so, Matt, maybe you can comment on historical, but kind of keeping a perspective.
Yeah, I think historically, obviously, the main ones that most people are going to remember would be obviously the .com, 08, 09, and then obviously COVID. But coincidentally, COVID was a positive year in the market, and obviously that had a lot of government influence with stimulus, but still positive. And so, but there's not a year really on this chart that doesn't have some type of negative number at some point in the S&P. Many of them down double digits. And so obviously we're not making a call here on what exactly the market is going to finish for the year, but it's not anything unheard of. We see it regularly, even last year, down 8%, the year before down 10%. So it's something that we're accustomed to, that markets do correct and have, just a reprieve of constant climbing. And I think that's probably where we're at, is just a little bit of a reset at this point, until, much to Beth's point, of there's really just clarity on what's going to stick. And then the capitalism markets will figure out, okay, how do we now turn this for profit long term, and navigate what this ongoing cost is going to look like to the country, what that's going to influence GDP, how the Fed controls rates, all of that, and people adjust their spending accordingly. So I think that's really what we're seeing here. Is it's nothing unheard of. And oftentimes we hear, it just feels different this time, and that I would agree with. It feels different this time, but it seems like every time that we have a pullback or a correction, it always feels different. But the resiliency of the U.S. economy just kind of seems to plow through. So our hope is that again, we just get some clarity on where things are going to go with tariffs and solidifying that, and then markets respond accordingly, which we believe are going to be positive.
Yeah, great.
Hey, I'll piggyback on that.
Yeah, go
Erik.
ahead.
This is one of my favorite charts to look at, and there's been, to Matt's point, there's been negativity every year. There's some, the market's down at some point every year. It just depends on where we end up. The other thing that I'm starting to hear is recession fears, bear markets, kind of what's going on, and there's some interesting data out there. So the average bear market lasts about 11 months, and it is down about 30%. So that's significant. But conversely, the average bull market lasts about 4.5 years, and it's about 150% growth. So when we do have these downturns, more times than not, and again, it's historical, but more times than not, we have a really nice rally after the fact. The other thing to take into consideration is up and down years in the S&P. So since 1926, the S&P has had 26 down years, average around negative 13%, but it's had 73 positive years, where it's averaged over 21%. So just like Matt said, this one feels different, but I think we can also go back to '08 and some other years and say those also felt different. And because of the strength of the economy and our country, we always make a comeback. So this could be something very similar.
It's great.
And I think the other thing to stress is we're in a different position right now with where the Fed is at. When I look at the Fed they're not looking to necessarily accelerate rate cuts. They're not freaking out at this point, which I believe stresses the underlying data in the economy actually look pretty solid. Obviously Bernanke makes comments that we got to see how these tariffs, change this data for us. But the fact that they're still kind of going down that same glide path as they see core inflation reduce, that's good news. It also just means that basically they have wiggle room. So the Fed has the ability to cut rates at a greater rate than otherwise planned to boost the economy. Where you go back a couple years and rates were at 0%, they didn't have that ability to help the economy. They basically just had to make rates climb just to control inflation and slow it down. But we're in a much better position right now with the Fed and where rates are at to help bolster the economy if things do begin to slow down.
Yeah, I agree. Jerome Powell's been very calm. He's been very to the point. We're going to start getting first quarter earnings reports in, and that may help to stabilize. We just need clarity. I think still approach with caution because it's a moving object. But I don't think there's any need to panic. I think that, as we learned today, we are going to take our disciplined approach. We are de-risking the portfolios today, but that's based upon data that supports that change. And that same data is not showing currently any imminent risk of recession. So there's still a strong economy underneath this, and we'll see where it takes us over the next, the second quarter.
Yeah, that's actually one of the questions, Beth, that you kind of already answered, but throw it out to everybody is, what are we doing? And I know the question was around, I know you communicate often and you keep an eye on it, but what's the data showing and what are we doing? And it's kind of appropriate this day. We didn't choose this day initially, but de-risking, is going to happen for our clients. And so, somebody want to jump and just kind of let everybody know if you're a client, you're going to see some communication and, what we're doing, and we'll keep you informed, but let's just give them an update.
Yeah. I mean, just to Beth's point, just today we received the most recent data, and it suggested that we do some de-risking. And, because we are data driven, that's extremely important. And sometimes the data doesn't feel good. We feel different as humans, right? We have emotions, we feel a bit different. But as we continue to follow the data, it's done extremely good things for our clients. And right now, the data is suggesting de-risking, which is what we're going to do throughout the portfolios. Not suggesting that there's a blow up coming up. It's just being cautious because the data is a bit, as Beth's point, a bit murky right now, and we just need a little clarity. So until then, we're going to take our foot off the gas a bit.
Yeah, so for de-risking, that means we're going to reduce the amount of equities in the portfolio and increase the amount of bond exposure. And this is ongoing. We have had subtle changes in the models that I feel have been quite beneficial over the past couple of months, starting in February with a small transfer, 5%. Of equities from domestic to international, replicated that move in the beginning of March. We did have a little bit of de-risking and reducing equity positions mid-March to take us to neutral positions. We've moved a little bit from big growth stocks into more value-oriented. And if you look at capital market indices, all of those changes have been beneficial. So for today, following the data, and I think it reflects the higher volatility that we've had over the past week or so. It just says, as a cliff, take your foot off the gas a little bit. We're not removing equities from the models. We're just reducing them. So in a position that if we do start ticking upward again, that we've got all of our clients will have equities in their portfolios to participate in that recovery or that growth moving forward. So,
right. And I think at this point we're a little bit more saying, hey, making sure we're protecting on the downside. And if markets stay relatively flat, we're actually going to pick up more yield in that fixed income to generate more cash into the portfolio. But also rates climbed pretty significantly. So buying in at bond prices on that treasury that has climbed also provides us with greater opportunity for share price growth in that fixed income market if rates do decline and the Fed does also their part of lowering rates. So there's still ample opportunity to make money in that fixed income space that could be just more just a better return, if you will, in the short term than what equities can provide with lower volatility. So that actually is it's a pretty comforting place to be, quite honestly. So I like the move, even though I don't like the move. Kind of one of those.
I do. I think that, our decision to use the two mutual funds in the fixed income space with the active management, hands-on portfolio manager dealing with, the huge bond market and the number of different choices that they could go versus using our primary bond position in an exchange traded fund, which is passively managed and follows an index. I really take comfort in the fact that we've got active management with decisions being made every day to deal with the changing conditions that we have every single day too. So I'm okay with the changes that we're going to be taking. You'll see trades being placed in the portfolio later today or tomorrow with all of that. Yeah.
I think we lost Erik.
I think he might be jumping back on, but do we have questions? I know Taylor's in the background. Do we have questions that we can answer for folks that may have been submitted? I think Erik had those too.
Yeah.
I'm back in. So sorry about that, folks. Had a little technology glitch. So you've got me? Everything good?
Do we have any questions?
Yeah. So we had a question on yield curves and how that's going to affect, all of our bond allocation or bonds and so forth. How are we thinking about that from the yield curve perspective? That I think the question also probably was a little bit from one of our charts that we had as well.
Matt, I think that's you.
Yep.
Cool. So yeah, we kind of just briefly talked about that, but I think what we're saying on the yields, I don't know if you have the chart, but if you look at the yield spreads of just corporate high yield, where things are at right now, that yield has climbed a decent amount. And again, a lot of that is just due to markets initially were betting that, hey, we're not going to have rate cuts because tariffs were going to slow things down in the economy, and what's going to happen, you're going to have to pay us more for de-risking. And so you saw this wave of people de-risking initially into fixed income markets, which were bumping up rates. Now you're seeing probably going to be the converse of the Fed saying, hey, we think we might actually begin to have more rate cuts. And so now you're going to probably see rates decline. So I think at the end of the day, we're still staying within this 50 basis points swing in fixed income yields on that 10-year treasury. It's just kind of bouncing around in the same spot. And I don't really think that we're going to see too much difference there until the Fed really begins to say, hey, we need to make a move, or until you see GDP growth slow down, that now the market is betting that the Fed is going to make some moves. So I think right now there's probably a little bit more stabilization than we realize in that space. And again, that bond market is way bigger than the stock market. So it is something that obviously the administration is paying attention to, Jerome Powell is paying attention to. That is not something that they take lightly. So I think at this stage of the game, again, de-risking for us right now, going into that fixed income, you're kind of buying in on the high end of that quick spike that we've had in yield curves, which gives room for share price growth as rates drop, so we can get some profit there. But you're also going to get paid a little bit more handsomely to be in that. And the more we have just kind of some of that credit spread on that yield curve, that's just going to benefit the portfolios a little bit. So again, I think it's a good place to be, and it's setting people up for generating profits when and positive returns when things don't feel very great.
Yeah, thanks, Matt. Any other comments about yield curves or the fixed income side? Another question is, we'll let someone else handle this, I guess. Gold, we're hearing a lot. We always hear when there's down markets, gold, Bitcoin, kind of some of these other, asset classes that, the discussion gets increased, right, when we have market volatility.
It does. And I have been getting the gold question as well. And I would just, apply logic or prudent investing, buy low, sell high. And gold is at an absolute high. So, that ship may have sailed a little bit. And, what we were talking about and hearing earlier today is that the huge kind of disruptor into the markets, I think happened last week with the application of the reciprocal tariffs, and then backing them out 48 hours later, which really whipsawed the market. And that may have been the inflection point. So will things continue to do this? Will we find that it's settling down? I'm going to express a personal opinion here. I don't mind a little bit of gold in a portfolio, but I think the opportunity to buy into this market may have passed at this point.
My personal opinion. Go ahead, Cliff.
Okay, I was just going to say.
Go, guys. Knock me down.
No, I'm not knocking you down. I agree with you, actually, Beth. So I think, we may have missed the run up with gold because now we are buying high. And there's speculation out there that it may make to 4,000, but it's already had a really good run. The other thing to think about with gold, because we always hear this, like you said, Beth, when there is turmoil in the market, we always hear we should be in gold. But if you look over the last 15 years, gold has had actually a good run. It's up about 7.5%. Conversely, stocks are up about 10.5%. So, equities still outperform even due to the volatility. So it's not bad to have a little gold, but it's not something where you want to stash everything.
And you have to stash it. You've got to find a place to put it,
Right.
and then worry about it. It sits on a shelf. They always say it's a hunk of metal that sits on a shelf and doesn't generate anything for you unless you're actively trading it, right? And you're trading on the up and down ticks on it.
Yeah. I think gold, in my opinion, serves really nothing long term for people, in respect of gold is not going to dig a country out of problems. It's the working class that digs them out of problems. There was plenty of countries historically that were rich in gold, and that didn't save them. And I think that's, sometimes we feel like gold is this thing that's going to dig us out of something. But as a hedge a little bit in the portfolio here or there, yes, I can see the validity of it. But I think it's when do you buy? It's a pretty manipulated commodity, in my opinion, with spot makers and spot pricing and how that's done. And it's a wild ride. So if you buy at the wrong time, you're going to regret it. So I think we've definitely missed a bulk of the run. Not that it can't run up a little bit more, but I'm not sure that it serves as massive of a position in a portfolio right now. That's Matt's opinion. That's not it. That's Matt's opinion.
So maybe Beth, I think just be helpful. I know clients hear from all of us, that we talk about and our process, and we talked about de-risking more today, but that when we upgraded our modeling and our process many years ago, this was kind of a time why we did that. So what we're experiencing right now is why we did that versus kind of a static asset allocation. And I think for our audience, just to kind of review that, the data really shows to be more active and do some protection on the downside, is really a positive to the longer term portfolio values. And maybe just share with our audience and kind of how we think about it and why we upgraded.
Yeah. We did make the change several years ago. And for me, my support of this change is really coming into play right now in having the data, having a process, not trying to guess as to what to do because this feels right or that feels right. Having something substantial, facts to rely on, which they're not always going to be right. The markets are a psychological thing as well. But I feel more confident in the advice that we're giving to our clients. I feel more confident in having rationale like factual rationale to support the recommendations that we're making. And it doesn't take away one of the hardest parts because you're still going to have folks who get very concerned, legitimately so. I was talking with a client yesterday who is reflecting back on 2008 and the hit that their portfolio took then. They are since long retired and truly do not want to go through that. They don't have time to make up for it. So there's still going to be situations where it's get me out, put a larger secure position in the portfolio. Well, the data is going to help us as well on the coming back inside of things too. We still have to wait for the future to play itself out. But I think we just bring a lot more confidence to the advice that we're giving clients and the rationale behind it. And as we were told many years ago, I'm not making investment. And I wasn't then either. I just like to say, making investment advice based upon what I heard on the radio on my drive into the office.
Yeah.
I don't know if that answers your question, but
that's great. No, that's a great explanation. Cliff, you wanted to add?
Yeah,
to that?
I'll just a little quick blurb here. I like to keep things simple. The other thing too, the data allows us is not so much to focus on the growth and trying to beat the market, but more so the net return. So, when things are bad and we are de-risking, obviously the data is, suggesting such, and we're doing it for behalf of all of our clients. But also what that's going to do is that's going to help the net return. So, the average investor in a portfolio like ours, more times than not, isn't going to lose as much in a bear or a correction as a typical investor that just is static, like you mentioned earlier, Erik. Just keep it there, leave it alone, don't do anything. Those portfolios typically drop more, whereas we're following the data, we're making the changes as needed, where our overall net return will be better.
Yeah. It's great. It's great. Thanks, Cliff, and thanks, Beth and Matt. Well, we'll wrap up here. I just want to say a couple things. One is, if you're a current client, that we ongoing communicate with you, and so we will absolutely continue to do that, and certainly we'll be bringing you other communication and maybe other webinars and so forth as the markets evolve and we continue to move on through the year. So we're here for you. You can always access us, by calling the office and scheduling a quick time with us. You've seen the communications we sent out. You can access our calendar really quickly if we just need to talk through something. But know that again, we're following a really data-driven process that the large investors, the institutional investors, utilize this process as one of their core decision processes. If you're watching this and you're new to Hilltop, thank you for watching. If your portfolio needs a tune-up, you can certainly schedule a 15-minute introductory call and find out more about your situation. And if we can help, we'd be glad to take a look at that. Lastly, I'll leave with if you are a client, we recently this year have been trying to increase our Google presence. So they tell me that's good. So if you haven't done so, a lot of people have. They've left us Google reviews. We really appreciate it. If you could leave us a Google review, that would be wonderful as well. So with that, any closing thoughts from any of the team? Said it all?
I don't know. I would just continue to look for clarity.
Yeah.
Don't make any rash decisions, whether it's on investments or spending. There's still more to come, and I think we need that clarity before making many quick decisions on things.
Yeah, I like that, Beth. Continue to look for clarity. So, all right. We hope everyone has a great rest of the week. Happy Easter to everybody, and we will see you or talk to you very soon. Thank you so much for joining.